one. Hi, everybody. Tony Martinez here with Negozi, and today we have a very special guest for everybody. We are streaming live on Facebook, Twitter, YouTube, and across multiple channels. We have the one and only Louis Rashe. Is that how you pronounce your last name, Louis?
Yeah, it's Rashe from Rashe Financial Network. How you
yes,
doing?
Yes, from
Yeah.
Awesome, man. So Louis is the founder, CEO, and chairman of the board of Rashe Financial Network, and we had to bring him on. We were trying to get him on like last week when everything was going crazy, or the week before, but finally, he is here with us. And so, Louis, how you doing today?
All right. So, I'll probably just start with discussing, some recent events. I mean, obviously, we've seen the stock market crash around 30% in the past month, right? And then recently, the announcement of QE Infinity. So, the markets have rallied 9%. I think we're probably not at the bottom yet. We'll probably slide some more. But just kind of going back to, what has led to this. This started much before even the coronavirus pandemic and the lockdown. I mean, we had in last year, starting in September 2019, the Fed was already doing $1 trillion bailouts of the repo market, injecting liquidity. So there was already problems in the system. There was already issues with liquidity. And then with the virus coming in and shutting everything down, the shock to the system has been immense. But I mean, this market was already overpriced and elevated anyways. It was going to crash. If you look at the Buffett indicator, and that's probably the best one to look at, according to the Buffett indicator, and I'm going to show a chart quickly right here. It was at 155% of GDP, right? So let me share my screen.
Go ahead and share your screen. Be able to let me know if you can.
All right, hold on. Let's see. Hold on, I'll have to exit and I'll rejoin shortly. It's an issue.
Okay, go ahead. So as we wait for Louis to come back on, we've been indicating that for some time now, there has been different indicators of the stock market coming, the bull market coming to an end. One specifically, I was at an event last December, and they were basically stating that a lot of the truck drivers, the trucking industry was seeing some different indications of the slowdown of the market. So that may be one indicator if commerce is slowing down or being affected.
I'm sharing my screen now. I just had a technical issue with being able to share my screen. Okay, so this chart, do you see it?
Yeah, we see it. What does that mean? So first of all, what are we looking at here? What is this over?
So this is the Buffett indicator, and it basically just shows what is the value of financial assets relative to GDP. Right there, you see, right here, this was the dot-com peak. It was one of the highest stock market valuations. This was higher than actually 1929 when during the dot-com bubble, we had stocks hit a high of 150% to GDP, right? So that means that there's more wealth and financial assets than there's actually goods and services produced by the economy. So that's obviously going to crash. And then,
so does that mean it's like overvalued? Is that what it means? That these financial instruments are
overvalued because you cannot have financial assets be worth more than the underlying productivity in GDP of the country, right? It just can't happen for any long period of time. Like right here, you can see, for example, let's say the 1980s, financial assets were undervalued. That's actually why we had a boom, right? But in the 2000s, dot-com, they hit 150% to GDP. In the most recent one, stocks hit 155% to GDP. So it's basically the record high valuations of the stock market relative to GDP. And this is the housing market. The housing market wasn't as overvalued. The stock market wise, it was mostly a debt bubble in housing, right? But see, the reason why 2008 was far more severe than the dot-com bubble is because in reality, stock crashes don't really affect um, stock market crashes don't really affect people as much, right? A lot of stocks are actually owned by the top percentage of the population, right? It used to be around 80% of stocks are owned by 20% of the population. Today it's like 90% of stocks are owned by 10% of the population. So the level of concentration of stock holdings and for the average person beyond their 401k is really doesn't have very little net effect. What people do rely upon heavily is credit. People rely on credit to buy homes, credit cards to, make ends meet, buy cars, right? So the 2008 crisis was far more severe than the dot com because the dot com was basically, oh, stocks crashed. Maybe you're a stock trader, a speculator in the dot com bubble. Maybe you worked for, some of these tech companies. But outside of that, really no effect. But, when credit seized up, and this is going to go into why this could be really severe because the stock market crash right now is bad, but there's a lot of there's a huge debt bubble in the corporate debt markets, right? Just like the housing crash was really severe because it wasn't, let's say, the stock market crashing, it's because credit markets imploded, right? Because of all the losses in mortgage debt, right? So here we have, obviously stocks were as overvalued today as they were in the dot-com, right? So things are pretty bad, but I'll kind of go into, this is the Buffett indicator. So right now,
Okay.
and this is actually today. So at today's prices, the stock market is 113% of GDP, so slightly overvalued, but it's no longer at 155, which it was just a month ago. But usually it will overshoot. So probably when this overvaluation drops, we might be in the 75 to 100% range. And I'll just kind of go give a good example of that. Let me see.
But I have a question there. So how do stocks become overvalued? Is it just like the funding mechanism that exists in capitalism that allows these companies to be worth way more than they should be, or what leads to the overvalued of these companies?
So a good way to think of it is money is debt, and when people borrow, right, they're creating money, right? But this money to be serviced needs to be serviced by either an individual's earnings, a company's earnings. So what happens is that, and earnings represent, real GDP, right? Usually the only way you'll generate real earnings, right? You might borrow money for a business, but to generate those earnings back, right, to, settle that liability, you need to go out into the marketplace and sell a good or a service, right? If, you can generate all kinds of debt and never generate, let's say, the amount of, goods or services to get that back and generate earnings to repay it, right? So in general, it becomes a disconnect, right? That's kind of like a feedback loop of, capitalism and in the debt-based economy, right? Earnings are what closes the loop, right? When people borrow, they create credit, money, right? And what closes the loop is earnings. So for example, you can have a company, they borrow money, they invest in their plant equipment workers, they create a good or service, they sell it. That closes the loop, right? And those earnings are, for example, maybe their workers are also their consumers. Now you can just have the company just borrow all kinds of money, buy back their stock, right? They're buying back so much other stock. It is pumping up the price of the share price, but it's not really improving the business earnings, right? So then, you have the stock price way up elevated. The earnings haven't actually changed, the company is not going to be able to service that debt long term because their earnings haven't changed. They just have more debt. So eventually, and it might keep on borrowing. They might even borrow money to service their operations, stay afloat. But eventually, doing that, if you don't have, earnings from borrowing, to service that long-term obligation, you'll probably, it's like a Ponzi scheme. You'll eventually go into default.
I got some oranges, okay?
Got it.
Oh, one. Okay.
All right. Yeah, that was just a quick interruption. But kind of
Okay,
going.
got it.
So right here, like you can see the GDP line, right? And it's usually a straight trend. Right here, you can see the bubble, right? It's pretty clear.
Yeah. So I know.
Right
I know what I was asking. Sorry. You just mentioned stock buyback. Do you think that the Tax Cuts and Jobs Act, latest, the largest, most in modern times tax legislation, led to companies, doing a lot of these stock buybacks, which led to the inflation of the stock?
So I think all the buybacks, yeah, I guess you could say yes. A lot of it went to mostly just corporate buybacks. I mean, a lot of it, they not only did they use it for corporate buybacks, they levered up whatever, because when a tax cut means instantly your free cash flow improves, right? Your net cash flow, because now it's like freeing up cash that normally you would pay in taxes, right? So then you can also even borrow money against whatever new extra additional free cash that you have because of the corporate tax. So they borrowed against it as well to buy back more of their stock. They did some investment in plant equipment, but largely it was mostly used for corporate buybacks. A good example, Boeing right now is saying they want $60 billion in bailout money, right? To get through the tough time. Well, Boeing has spent $43 billion already on corporate buybacks. It's like, okay, you probably wouldn't need the $60 billion bailout if you didn't just spend $43 billion over the past couple of years buying back your own stock, right? But I mean, from Boeing's perspective, a good way to think about it, if you were running one of these large corporations, right? Just imagine yourself as the CEO of Boeing, and you're like, okay, well, we're earning money. Our corporation is earning money. I, as CEO, most of my compensation is based on hitting stock price targets. So I can get the stock price to go up, by improving company earnings. But, obviously, as my business scales, it'll hit a natural limitation to that, right? There's, like maybe, you hit the, market saturation, and maybe you're not going to grow as fast, right? You just can't have, let's say, double-digit growth forever, right? So, for example, you're like, okay, well, we can increase our earnings per share artificially, not through growing the company's earnings. And this is actually even quicker. I can hit the price targets, and then I can get all my stock awards and sell them, right? And to do this, I can use the company's, its earnings, lever them up, and borrow all kinds of money, do stock buybacks, right? And just keep on borrowing money to do stock buybacks. And that will improve the share price, right? Regardless,
which will make all the shareholders happy and all the executives happy with the stock going up.
And then you dump all the shares. And I'm sure, well, a lot of CEOs were actually doing this. A good sign of there was trouble coming. I think there was like around 1,300 CEOs had quit at the beginning of 2020. Just right before all this happened, and they've been quitting all last year too. And I'm sure they're all like, well, we loaded up our companies with debt, we bought back all our shares, right? We're rich, we're running to the hills. We get out, next guy can be the fall guy. It's not our problem, right? But a good
That sounds
example.
scandalous.
Oh yeah, a good example though of how you can tell too of the stock the stock boom. I mean, right here you have 2008, which lasted around, I would say, 8 months. So honestly, this market has only dropped for 1 month, and people are already rushing in to buy. I would probably wait a little bit longer, right?
Well, yeah, okay. So that's basically the theme of today's live is should we buy stocks now or wait? So you're suggesting that even though they're low, that are you saying they're going to go lower than what they are now?
They're probably going to go lower because this chart, I just got it today. And this is, the total stock market. Wilshire total market is basically the total stock market, right? All of them together. And right here you can see .com, the 2008. This one hasn't even reached what you'd call the mean reversal, right? Everything is going to return to the mean. It always does. But usually it overshoots. So we're not even undervalued. We're still technically overvalued, right? So it still needs to drop at least to the mean line, probably below, maybe 20% below the mean. So I wouldn't be buying now, right? But it depends on how big the Fed's bazooka is, because that could make anything inflate, right?
Okay.
They really put money into something.
Could you tell us a little bit about that? Because so the Federal Reserve, and we're getting a lot of comments right now saying thank you for this, learning a lot. So could you explain to the viewers, like, what is the Federal Reserve? What do they do? What's their purpose? Are they part of the government or a separate entity away from the government?
So the Federal Reserve is part public and private, but it is largely a private organization. And what it is it's basically a trust between the banks. It really works for the banks. It principally exists to save the banking system. That's what it was created, in 1913. But in kind of going back in a little bit of back history, in 1907, we had a severe financial crisis. And during that crisis, we had JP Morgan, he got together many banks and financial institutions together and organized a bailout, during 1907 panic. Even bailed out the US government. So the US government created a central bank because they're like, we don't want, a private individual to have that kind of power. Right? So that's why we have it. But it largely does exist. And a lot of people get upset about this. They're like, oh, why is the Federal Reserve bailing out the banks? It largely exists to bail out the banks and prevent bank runs, right? When people run to cash, it is the job of the Fed to act as lender of last resort. This has been its historic role, to be lender of last resort since it was created, right? Because before the central bank, we would have regular runs on the banks. And because we didn't have what they call an elastic money supply that can expand or contract as needed, people would just run to the bank would run out of money, and then they'd collapse, and all the deposits would just evaporate. Right?
Which leads to panic and further bank runs, and a lot of people trying to withdraw cash, huh?
Yeah. So today, for example, like recently, Neil Kashikari said that don't worry about the banks, don't worry about the ATMs or your deposits. We're guaranteeing. Even if your bank doesn't have enough money, there's unlimited cash at the Federal Reserve, right? So that means if anybody hits up the bank for, a cash run right now, what they're saying is we're doing infinite guarantee, right? Which means if everybody pulls out their money, they'll be able to conjure all the money, inject it into the banks, and then they'll pull it back out, right? And it gets a little bit more complicated. They have term repos, right?
Yeah.
Because in reality, money isn't a permanent thing. It's not a permanent construct. A good example is, in simple terms, let's say if the Fed says we're giving out $100 billion 14-day repo to the banks, that means that it's a 14-day loan that money, that $100 billion given to the banks exists for 14 days. And as soon as it's repaid, it ceases to exist, right? Money is created and destroyed manner, right? And that's what, people think money it just expands, but it can also contract, right? So when there's short stress, when people are like saying, we want all our money at the same time, they're like, we will expand the money supply as much as right? And then they'll pull it back, right? After blows over, right?
Yeah.
But one of the things I kind of want to go over too, which is
please go ahead.
U.S. corporate debt as a percent of GDP is at an all-time highs, and during 2001, during the dot-com bubble, it hit 45%, and then 2008. 9, it hit 45%. We're already past that. So corporate debt right now is at all-time highs. And I think this is the real reason why they're giving out all these bailouts, because if the stock market crashes, it's bad, but not too bad. But if credit seizes up, that's going to be really bad, right? A lot of companies are able to get through this because they're able to draw upon their credit lines, right? Like you have many companies right now are maxing out their credit lines to just stack cash on their balance sheets, right?
Got it.
In the normal, market, if the Fed wasn't intervening, these credit lines would probably either have frozen over, right? Credit markets can freeze over, which would be really bad, and also a lot of the credit would get downgraded. And a good example, and this really goes into how bad this buyback scheme is. So this is 2008, right? Right now we have record levels of corporate debt, 10 trillion, and we have record percentage of that corporate debt is triple B, which is basically one grade above junk, right? Junk. So basically, you have what investment grade debt and then junk debt. Yeah. So right now, you have all this corporate debt that has been issued sitting at triple B rated. If this stuff gets downgraded to double B is considered junk rated. So, you have a lot of companies that will be in trouble if their debt gets downgraded to double B or less.
But then why so? Because first of all, how do these corporations even access this much capital? Who's lending them this money? Is it the major banks? Do they go to like Wells Fargo and Chase and just get a loan like anybody else, or is there like Goldman? Is that where Goldman Sachs comes in and all these private like corporate like funds, or how does this happen? This capital.
So you have shadow banks, you have banks. We probably one of the big lenders right now is what they call shadow banks, and actually a lot of people have interacted with shadow banks. Like, have you ever seen like those online mortgage lenders? Like I think there's that one rocket ship one, and just like these mini online lenders. Well, those are actually considered shadow banks. Right. There's a lot of restrictions placed on banks regarding buying it, but actually that's why we have another housing bubble. We can go into that too. But the current housing bubble, there's less exposure in this housing bubble from traditional bank lenders because they have restrictions. Although they are exposed to it because they've been pumping in all the money into the shadow banks, which are basically like, all these online lenders. They're outside of the Fed umbrella, right? Under the Fed umbrella, you have, the primary dealer banks, right? And the banks.
Yeah.
But there's all these other players that are not, hedge funds, these online mortgage lenders, right? Although they have been getting, money from the government through government guarantees, a lot of FHA loans, a lot of other type of loans. But for corporate debt, what they do is, let's say, you issue a bond and then someone buys it on the market. So a good way to think about it is when you go to get a car loan, your car loan is a bond, right? And whoever let's say whatever bank or institution gives you, let's say your 30 grand to buy that car, they're the buyer of your bond, and then they package that up with other bonds, and then they sell it as a security, right?
Okay.
People
Got
don't
it.
think of it that way, but when they issue debt, someone is buying their debt, and they're giving them money for it, right?
Oh, got it. Hey, I just got a quick comment, not to interrupt you, Louis, but somebody's saying that you should invest in airlines before the bailout and then sell after it. What do you think about that?
So the airlines,
Yeah, should you invest now before the bailout,
I would probably
or is
wait
that?
after, because if you invested in now, they have a lot of debt. That means that they could go to zero. These airlines could cease to exist, right? This is why they're so desperate.
Oh,
They have a lot
got
of
it,
debt.
got it.
They could go default, bankrupt, and then your shares. People,
Then you're screwed, huh?
get that stocks can go to zero, right? So I wouldn't.
Yeah.
So basically, as long as they're in that limbo, I mean, normally, two things you would do if you knew a company was in deep trouble, had a load of debt, you might short it. But because these guys might get a bailout, you don't want to short it because they could get their bailout and then go back up. You want to wait till after the bailout. Right?
So I have a question though. So why do these airlines have so much debt? Is it because their margins are so low that they never run a profit, or is it because of the stock buybacks that happen?
Stock buybacks. They're at.
So the stock buyback. So what? That sounds like it's a big factor of what's going on right now, huh? The stock buyback.
Boeing says we need a $60 billion bailout, and they spent $43 billion on stock buybacks. You can look this up.
Yeah. Hey, so my question is, like, screw them, right? All these big corporations who did stock buybacks and maybe gave their executives bonuses. Why should we bail them out? Why not just go bankrupt and just they cease to exist? Is it because of the jobs that they produce? Is that the only reason we're keeping them alive?
I think it was Southwest Airlines CEO that made a comment, and he said, "Look, we need a bailout because we can't keep all these people employed." So, and to Congress, that makes them really nervous. Congress is like thinking to themselves, like, "Man, we just need to give these companies handouts because we need them to keep these people employed." So, they're hostage. Hostage.
Yeah, well, it seems like all these politicians, all they care about is job, which is good, obviously, producing jobs. But then, I mean, like, shouldn't the market like adjust? Like, say the Boeing and the airlines, they go bankrupt. Those people have to find jobs somewhere. Can't they just find a job somewhere else? And another corporation comes and it exists, and the market cleans up like naturally, or no?
Yeah, that would happen, but that would take time, right? For someone else to and acquire all those assets, right? But I would say that it is correct, bailing them out is rewarding them for, terrible management decisions. If we had, real capitalism, right, which I hardly call what we have now is capitalism, right? They would build, and other companies that have managements that don't do reckless things like this would take over, cleaning out all the junk. But this has been going on for a while. I mean, we've been doing these bailouts for so long now. I mean, we did them in 2008 in the .com. Now to unwind this by just letting this clear out would be even worse, right?
Oh, I got a comment right now that says United Airlines is up 35% just today on speculation that the bailout is imminent. What do you think about that, Louis?
I think it's very likely that they'll get a bailout. Congress is very nervous. They know that they need to give them a bailout. That's the one thing I would say right now is, but I wouldn't really say it's about the bailout specifically why they're up, because they just announced, the Fed recently just announced QE Infinity like yesterday, right?
What does that mean? QE? I know I heard you talking about that yesterday, and then sounds kind of crazy. What does that mean overall?
They basically
QE
said
infinity.
that we will provide unlimited amounts of money to the system. We'll buy everything, right? We'll buy stocks, right? We'll buy, junk debt. We'll buy corporate debt. We'll buy municipal bonds. I'll give you an example. Right now, they're buying municipal bonds, and they don't do this. They're going to buy everything, of course, but municipal bonds are what basically like your local government issues. So, for example, let's say our community of Salinas, right? Our city municipal bonds to finance things that occur in Salinas, right? Our local police departments, other services, right? Well, they're bailing those out because I think a lot of cities in America are basically bordering.
Oh, the cities,
right? So they're like, well, we need to keep local services operational, so we'll just buy their debt too.
Yeah, God. Oh, I was reading today that a lot of the counties in America are having fiscal issues because number one, the tax revenue is drying up, right? All the restaurants are closing, all the small business closing, and now like the cost rising to care for the well-being of the residents in the county and let me ask you this. I'm gonna lead to this. They keep saying that soon our hospitals are going to be overrun with coronavirus patients. What do you think about that? Is that as true as they say that is, the whole pandemic, that we should just wait and soon our hospitals are going to be overrun? Millions of people are going to die in the country?
So, I mean, you could look up online. I mean, they track this live data of like how the pandemic is doing right now. But I really think it's very early stage. Because the pandemic has only really started in America. Like people saying, oh, we can just lock everything down for 2 weeks. I mean, for one, if you actually read about, herd immunity, right? To achieve herd immunity, you need to have like 80 to 95% of, people, let's say, vaccinated, right? Like, let's say, if people have an illness, either vaccinated or they have to get the disease and survive. So you remember, like Gavin said, California, right? 56% of Californians are gonna get, could get coronavirus. I think he's being a little on the low side because 56% doesn't sound like high enough levels to achieve herd immunity, right? You really need like 80 to 95%. And if you look at any other disease, the vaccination rates have to be 80 to 95% for people vaccinated to have herd immunity. Currently, coronavirus has no vaccine. So the only way to become immune to coronavirus or COVID-19 is to get it and survive. Then you're immune, right? So then in reality, right now, let me see. And actually, I had this chart because I wanted to discuss this too.
Perfect. Thank you.
We have like they're just trying to flatten out the curve so it doesn't overwhelm our healthcare system, right? Technically, you could just let everybody get infected, and then we could achieve herd immunity faster, right? Get to the 80 to 95% of people have gotten coronavirus, and then no one else can get infected because now we have a high enough herd immunity to where it just can't jump from people to people too much. But obviously, the other risk is that diseases can evolve really rapidly because of their replication rates. So let's say if mutate again, then whatever herd immunity we got is gone, and then you restart herd immunity again, right? So as long as this COVID-19 doesn't mutate, once it reaches, let's say, 80 to 95% of people either got the disease or they develop a vaccine, and 80 to 95% of the population gets this vaccine, we're nowhere near close to herd immunity. So they're just flattening the curve. That means that this thing is going to take a lot longer than people think. People think, oh, you could just lock it down for 2 weeks. It's probably going to last months, maybe toward the end of this year. Right. So I don't know, but I think, the unlimited money that they're going to pump into the system will probably could help the markets. But as these things drag out, this situation is probably going to get worse. because in reality, you know, they're just trying to flatten out the curve. They're not stopping it, because you only can stop it with a vaccine, or with when enough people in the population, you know, 80 to 95% get it, and we achieve true herd immunity. Because otherwise you can't just let people out, because, you know, if everybody hides out their home, right, and maybe, you know, you reduce the chance of you know, people getting the disease, but, you know, it's still out there. That means as soon as they go back out, because they haven't been infected yet, these cases will just explode again, right? Because we don't have herd immunity,
God.
right? Unless you were able to totally starve it out, you know, which, you know, would be pretty difficult, right? But that's kind of where we're at. And actually,
Yeah, I got it.
and this is another one that I kind of wanted to show. This is actually the .com. You know,
Okay.
this is kind of like where we were at, especially with that blow off top. You know, all this is just like
Wow. So basically, so that's okay. So let's start from 1990, the 90s, right? The 90s saw good, and then right before the .com. Oh, okay. So isn't that due to a lot of just investment into these companies that weren't even producing any sales or any earnings, and they were just being pumped up because of speculation?
Yeah. So a good way to think about a stock is basically is just the discounted future value of earnings. So you're giving up cash today to buy more cash flow from the future, right? So like, for example, let's say, you know, you predict, at least currently, you know, if I give up this amount of cash, I'm going to make this much over, you know, maybe based on you know, the underlying earnings of the company, right? But here you can see, you know, it peaked out and then it crashed. And I think right here, this is where we're at. We're at the dissipation period, but we haven't actually reached the the overshoot, because, you know, the current, you know, according to the Buffett indicator, we're still overvalued, right? Not by much, 130